I think, as the sponsors are working towards passive house and passive house certification, that the lenders are now becoming more aware of what passive house is, and how that is, the preferred path forward for green building certification.
Welcome to the Passive House Podcast, brought to you by Passive House Accelerator, a catalyst for zero carbon building. For news, inspiration, and connections from all flavours of Passive House, check out passivehouseaccelerator.com. Sign up to receive regular updates about events, get your questions answered, and contribute to the community dialogue. There's loads of free information for experienced professionals and people just starting out on their Passive House journey. We hope to see you at one of our weekly Passive House Accelerator live webinars. In the meantime, here's this week's Passive House Podcast.
Welcome back to the Passive House Podcast. I'm Matthew Cutler-Welsh, coming to you from Tamaki Makaurau, Auckland in New Zealand. And we've got the whole crew back with us today. So let's start with Mary. How are you doing? How are things in California?
Things are great. We had a very fun Thanksgiving long weekend. That was wonderful. And moving into December shortly with beautiful California fall weather.
Yes, happy December. Ilka, coming to us from Philadelphia. How are you doing?
I'm doing well, and everything's great here as well.
Nice. And Zach, how you doing?
I'm good. Seattle's wet.
So any standouts from the first news coming out of COP?
Well, it looks like they've made a decision on this first day, which is a first. That there's been a pledge to fund the loss and damage fund. Unfortunately, the pledges that are coming in for that are not commensurate with the magnitude of the problem that we're trying to address here. So this loss and damage fund, the pledges are $100 million from the UAE, $100 million from Germany, 60 million pounds from the UK, $17.5 million from the US, which is less than many multifamily buildings cost to build. It's pretty pathetic. So that part's kind of frustrating, or very frustrating. Japan, 10 million. So one of those things where, hey, it's great to get a start, I guess, but wow, we need to see bigger dollars in that fund.
Yeah, it seems that it's being reported here as a positive signal, as a starting point.
Yeah.
But it's sort of orders of magnitude less than what's really required to get things addressed. And this is just talking about, this fund is for damage that's already occurred, isn't it? Or likely to occur, loss and damage. This isn't actually about reducing emissions. This is just recognizing that there's real loss already happening. I mean, I think some of those, even local events here, eclipse some of those numbers in terms of damages that we've already experienced just from storms and events. And we're a relatively small country down in the corner of the world. So lots more work to be done. I guess we'll keep an eye on COP over the next week or so and see what else comes out of it.
Yes, it really is a small number compared to, at least in the U.S., last year we had 18 separate weather and climate disasters that were at least $1 billion in damage, which, so 17 million, 18 disasters that cost at least $1 billion each. It's a little out of ratio there, but it's a start.
Yeah. We certainly needs a lot there. So it is good to see a positive signal coming out fairly early on in those talks. I know there are always a bit of controversy surrounding those, but I think there's some progress being made. Awesome. We're going to jump into a really cool interview this week, but we've got a couple of things to also talk about before that. But before we get into that, do you want to do a quick shout out to our supporters, Zach?
Yeah, absolutely. So a big thank you to our founding sponsors, 475 High Performance Building Supply, Baxt Ingwe Architects, Glavel, Minotaur, Partel, Rockwell North America, Stocorp, and Zola Windows. Thanks too to our champion sponsors, Bewizo, Gradient, Icon Windows and Doors, Intelligent Membranes, PH Air Seal, Proseco, and Source 2050. And a big shout out to our stakeholder partner, NYSERDA, the New York State Energy Research and Development Authority.
Awesome. So some other big news out of the accelerator this week, Zach. Tell us all about that.
That's right. And we kind of alluded to this in last week's episode, but we rolled out the formal announcement of our big 24-hour online conference, Reimagine Buildings 24, which will be on March 7th and 8th. And we have a little intro reel that we're going to share now. So let's listen to that. Imagine you could learn about 24 of the best buildings solving for climate change, instantly become part of a global movement, and gain the knowledge you need to create real change in what you do every day. Join us for a one-of-a-kind, 24-hour, around-the-world, global online happening, Reimagine Buildings 24. We'll circumnavigate the globe, unveiling a new, innovative building project every hour, complete with actionable solution sets, expert insights, and key lessons learned. We'll connect you with peers from around the world and from your region, so you can build the network you need to create buildings that make a difference. We all know that time is of the essence, that climate change is already here, and that today, too many of our buildings are not only making the problem worse, but also leave us vulnerable to climate extremes that are already here. But that's all changing. A global movement is turning it around, reimagining buildings as resilient and healthy havens, as climate solutions. Tradespeople, builders, architects, engineers, developers, policymakers, and just regular people making it happen on the ground on every continent of our beautiful planet. Join that movement at Reimagine Buildings 24. Woohoo! So we've got a registration link. So that's a video actually that you can see on YouTube, and we'll include a link to that in show notes, as well as the registration link to sign up.
Yeah, definitely check that out, because it is you got the essence of their that in the audio, but check out the video, because it's really well put together. Hopefully a good sign of what's to come. 24 hours, new project every hour. It's around the globe. It's I think it's a one of a kind. I'm not sure if it certainly hasn't been done in Passive House world that I know of. So and I know it's created quite a lot of buzz already from Passive House affiliates and other associations around the world. So looking forward to it.
Yeah, we can't wait. We have a whole bunch of community partner organizations. You mentioned affiliates who are partnering with to make it happen. And we're getting some really great speakers on board for this. So we'll be rolling out a whole bunch of news as it goes. But sign up and secure your spot.
Yeah, awesome. All right, thanks for that. Now let's get into this week's interview. Katelyn Meehan, Ilka or Mary, do one of you want to tell us a little bit about Katelyn?
Sure. She's a relationships manager at Wells Fargo in the community lending and investment platform, and helps us understand exactly what that is for those of us who aren't involved in construction financing.
Yeah, this is great. I don't know that we've had someone who's in the banking industry. I know we've had some people who have financed buildings and some other developers talk about the financial side of Passive House on the show before, but this is great to hear from someone with an urban planning background, but embedded in that finance world. So really, really fascinating. So here she is, Katelyn Meehan.
Welcome, Katelyn Meehan, to the Passive House Accelerator podcast. You're a relationships manager at Wells Fargo in the community lending and investment platform. I'd love to hear about what exactly does that mean. Can you walk us through what you do for a typical project in your work?
Well, thank you for having me. I'm very excited to chat with you. Yes, my name is Katelyn Meehan. I work at Wells Fargo as a relationship manager in the community lending and investment group. Our team sits within the commercial real estate bank. And so the community lending team is made up of debt, LIHTC equity, CDFI investments, and new market tax credits. So I am part of the debt team, and I work out of the New York office. And so my team provides primarily construction financing to affordable housing transactions in the New York metro area. We also do some lending upstate, as well as Boston, Massachusetts area, and the metro New Jersey area as well.
And your background is actually in urban planning, right? What got you interested in housing finance?
Yes. My undergrad degree is in environmental science. And then I spent 2 years in the Peace Corps in Peru doing economic community development. And while I was there, I was researching grad school programs because Peace Corps offers a lot of benefits for grad school. And I came across this profession of urban planning, which I had never heard before. But it was the intersection of everything that I was super passionate about in terms of planning, resiliency, sustainability, so environmental justice, social justice, and economic development. And so it just sounded like the perfect opportunity to be able to have a touch point into all these areas. And so I went to NYU Wagner's urban planning program and actually focused on infrastructure, resiliency, and the environment. And my first role was working in the economic development group for Suffolk County on Long Island. And we were looking to implement bus rapid transit. But it was 2014 and we were coming out of the '08 foreclosure crisis and still dealing and grappling with a lot of the zombie properties on Long Island, which there was a large number of, as well as working on initiatives to transform Long Island Railroad, which is the commuter rail on Long Island to New York City. So converting those parking lots into multifamily housing. And just the pace of the real estate finance versus the 15 to 30 to 50 year planning of transportation planning suited me a little bit better. And I found it just to be a bit more transactional. And so I wound up going into affordable housing. And at the time, Mayor de Blasio was recently elected with a huge housing initiative. And so the city's Housing Preservation and Development Agency was hiring. And so I transitioned from Suffolk County to New York City's HPD, which is their affordable housing agency.
And then from there, you went to Wells Fargo. So can you just tell us what got you into your present position?
Sure. So at HPD, I worked first in their inclusionary housing group. And there we were implementing the voluntary inclusionary housing program. And then they had recently rolled out the mandatory inclusionary housing program. So that focuses on whenever the city allows for rezoning, as part of the rezoning, if you hit a certain threshold of square footage or unit size, you're required to provide affordable housing in that building without subsidy, and that the zoning bonus is what would provide the additional proceeds in order to subsidize or supplement the affordable housing. And then from there, I moved to HPD's credit and underwriting team, where we would review all of the subsidy loans that the agency was providing to the developers. And that really piqued my interest in focusing on affordable housing finance specifically. And so started interviewing at some of the lenders who were active in the affordable housing space in New York, and wound up landing a job at Wells, who is the #1 affordable housing lender nationally and plays a very strong role in the New York market as well.
And how did you get interested in Passive House, and how does that fit into what you're doing at Wells Fargo?
So to tie back to my environmental science degree and my earlier attempts at working in sustainability and resiliency efforts, I wanted to bridge my current role in affordable housing to, bridging that to the built environment and how we can connect the affordable housing goals with the resiliency and sustainability goals. And so a colleague of mine was on the Passive House Network board and asked me if I was interested in joining, and I was, and it's an amazing organization, and they're doing great work. And so it's been a great opportunity for me to bridge and align my professional goals with the sustainability and passive house initiatives as well.
Does Wells Fargo, so of course you finance affordable housing projects in your work. Does Wells Fargo have green home certifications that Wells Fargo awards any sort of financing benefits to, such as reduced interest rates or any sort of reduced fees, or does it have a program like that?
Yes. So introducing a new program at a bank is extremely challenging, and it takes roughly about 18, at Wells Fargo specifically, it takes roughly about 18 months to go through what we call a new product program and approval process. But we are very excited that we are recently able to roll out what we are calling a green loan commercial real estate program, and it provides pricing benefits in the form of an interest rate reduction for rehab loans, new construction, and term loans based on different tiers of efficiency that a building is able to hit. And so in tier 1, which is the top tier, which provides the most benefit, you are required to get a green building certification. And I was very excited to see and advocated for Passive House certification being one of the green building certifications that qualifies you for the pricing benefit.
So is Passive House something that's well known amongst the lenders? Because I remember I was working on a project back in 2014. It was a 40-unit multifamily project, and I found myself in a big boardroom trying to explain what Passive House is. Has that changed by now? Is it well known?
I think it's starting to change. I think people who are in the know, like most things, I think people who are in the know are actively aware and pursuing Passive House. I would have, I think for many years, LEED was, out there in the zeitgeist for what a sustainable building is. And I do think that, we're starting to shift a little bit away from LEED being the building certification that people are striving for. I would say on the lending side, the proposals that are starting to come across my desk in the past year or two from the sponsors, right, who are looking to receive financing from the city or state housing agencies, are promoting that their buildings are Passive House Light. And so it started as Passive House Light, Passive House Features. And now I would say within the past 6 months or so, the proposals that are coming through are stating that they're actually getting the Passive House certification. And so that is, of the green building certifications, that is the only one that I am seeing, at least in the New York City market. So I think, as the sponsors are working towards Passive House and Passive House certification, that the lenders are now becoming more aware of what Passive House is, and how that is, the preferred path forward for green building certification.
That's really interesting that you're talking about Passive House Light. Like, who determines?
It's sponsor determined. And I think, but to say that there has certainly been a progression, just even within the past year, of working towards certification, as opposed to just talking about Passive House qualities and standards, I think is a great improvement.
Yeah, I mean, if you go with certification, then it basically takes all the responsibility of judgment of the lender.
Correct.
Yeah.
I'm really interested in why it was that Wells Fargo adopted this new program, do you think that finance in general is starting to demand more accountability from the construction industry? Like, is finance more aware of the hazards of not of developers not thinking about climate change and climate change risks to their properties?
Yeah, absolutely. And, Wells Fargo has, you know, Wells Fargo plays a large space in the real estate finance market. And so, from our perspective, it's critically important that we are aware of the transition and energy risk of our portfolio. Oftentimes or primarily Wells Fargo is providing construction lending. So we don't necessarily have as much long-term risk as, say, Fannie or Freddie does from an agency perspective. But certainly our ability to receive takeout financing is predicated on the type of buildings that we are financing to be built. And so, so one, it's part of Wells Fargo's values. We have a strong commitment to resiliency and efficiency and sustainability. We have a $500 billion goal for deploying financing in those areas that we are looking to target, and we are on target to reach. And so we are looking for ways that we can be an active participant in this area. And we're fully aware that from an insurance perspective, from a resiliency perspective, that these are areas that we need to invest in to make sure that our proceeds are being applied in a way that resonates with our values.
Sorry, can you just clarify what takeout financing is?
Sure. Sorry. So when we provide a construction loan, we are looking for an end loan to repay our construction loan. And so in the affordable housing space, at least in the New York market, oftentimes we have forward committed takeouts, meaning that when I provide my construction loan, that we already know on the back end, there's a commitment on the back end to from either the state or the city or one of the, Fannie or Freddie, to provide the proceeds that will pay down my construction loan. In the market rate world, there are not forward. You're typically providing construction proceeds without knowing what the takeout is. And so there's a lot of variables in your underwriting, utilities. And, we've seen this coming through COVID too. It takes, especially in New York with permitting and all the city sign-offs needed in order to get your certificate of occupancy. It can take several years to build a building. And so based on what your underwriting projections are at close to what they are actually when you are leasing up your building, you want to be able to make sure that, and during COVID, we saw such deep fluctuations in utilities and insurance specifically. And so those are, just happen to be two things that can be impacted by building with a sustainability tilt or building to passive house standards, which can help mitigate the variability in utilities specifically. And then we're hoping that the insurance markets as well can start to identify and add value to resilient buildings, and that makes them more insurable, because really insurance, I think, is the next biggest issue that the commercial real estate market has to face.
I was just wondering if you yourself have worked on construction financing for passive house projects yet?
So nothing that has been certified passive house. We were moving towards a space with the city and state housing agencies where we were underwriting utility savings based on solar panels being in the project, or based on the mechanicals being provided that were being offset by the solar panels. But given the stark increase between what utility, because we underwrite to utilities in 2023. And so when the building comes online in 2027, or, for example, are because they're affordable buildings, right? The AMIs are restricted. And so we aren't necessarily, it's not like we're able to take huge gains in the rental market if there were to offset the utility increases. And so, instead of tacking on more debt to a project and potentially jeopardizing its viability, once it's stabilized, they're kind of allowing for, if you can gain utility savings via the solar panels, that's great, but we'll allow for that cushion as opposed to trying to underwrite deeper savings. Hopefully, as the market stabilizes, we start to get a better understanding of what the actual long-term benefits of these buildings are, which we don't necessarily have a strong data set right now for large multifamily buildings with these sustainability enhancements, geothermal, solar panels, all electric, et cetera. Maybe we can start again to reevaluate the ability to underwrite savings, but for the time being, there has been less of a focus on that.
Yeah, that's interesting, because in the beginning, when Passive House came out, especially with multifamily, it was always the idea, okay, maybe it costs a little bit more upfront, but your monthly payment stays the same because there's savings on the utility side. Correct, but that's not something that you're regarding right now. Did I understand that correctly?
It's especially challenging in more urban environments or in more dense environments as well, because the rooftop of your building for solar panels, for example, is much smaller and not necessarily able to offset a lot of costs at the building level from a utilities perspective. But one thing that I would say is that we aren't seeing when projects are coming across, with Passive House features, or even, if I'm looking at a budget that is going through certification, one positive thing I'll say is that we're not seeing we're not really seeing a difference in the budget at all. And so, it's very costly to finance these affordable housing transactions as it is. And so it seems like the cost of including these improvements and these quality assurances is not really tipping the budget one way or the other. So they're able to be financed.
That's really good to know.
And that's also offset in New York specifically. If you are providing solar panels or geothermal, we will see, grants from NYSERDA, which is the New York State Energy Research and Development Agency, as well as some new tax credits from the state coming out as well, which are incentivizing energy reduction.
Right. I was going to ask, and is there any programs through the IRA that has affected your work at all?
We're starting to see 45L credits in the underwriting. The amended 45L tax credit applies to qualified energy efficient homes acquired after December 2022 and before January 1st. So I think it was increased maybe to $5,000 a unit through the IRA. But there's a number of different small tax incentives that we've been seeing coming through the IRA. The problem in New York is that these projects are so costly, and at $2,000 to $5,000 per unit, it's a small investment, I think, for the live tech investor, which is typically investing, at least in the New York market, anywhere from $50 to $100 million per transaction. And so it's a bit more challenging to make these smaller investments, and with the compliance associated with the credit, I think sometimes doesn't necessarily offset the smaller investment. And so we'll see them in earlier versions of the budget, but then maybe the city or the state will decide to come in with more subsidy and just provide subsidy as opposed to going through the machinations of having the credit delivery. But just speaking more large scale, I would say not necessarily in our part of the bank, but in our REEF, which is our renewable energy, I forget if it's equity fund, but basically the group within the bank that does our purchases the renewable tax credits. They've certainly been way more active in the past couple of years as demand for these energy tax credits has increased.
Yeah, unfortunately, in a lot of energy efficiency programs, it's not uncommon that the compliance hoops you have to jump through don't justify the the savings that you get out of doing it. So I'm not surprised to hear that. But yeah.
And one thing I will say just generally is that for institutions like similar to Wells Fargo, is that we only have so much tax credit appetite, and especially since tax liability went down with the tax reform in 2017, is that it's a zero-sum game, and so that if we are, we're either financing, more in LIHTC or more in energy credits, and we can't just continue. We don't have an endless appetite, and so we are constantly having discussions about the best way to deploy our tax credit investments.
That's one thing in, much smaller single family residential, at least here in California, that the IRA is changing, that the rebates and incentives are actually making it worthwhile, or actually large enough to make it worthwhile to comply with the requirements to get it.
Yeah, I was actually going to ask as well about if you know anything about the single family home market, if the financing is changing there a little bit from the investor or the bank side besides the tax credits.
So at Wells, my role is specific to multifamily housing finance. I would just say anecdotally, just from my involvement on the board and just generally, is that for single family homes, it's primarily driven by the utilities. And so they're the ones that are offering the incentives and the ability to, change your mechanicals or to provide solar panels, et cetera. Those types of upgrades are mostly driven by the utility companies.
Okay, well, another area of your not exactly work life, but in addition to serving on the New York Passive House board, I noticed that you also serve on the board for Women in Housing and Finance. And can you tell us a little bit about that organization and what led you to serve on its board?
Sure. So that is an incredible organization. It is based in New York City. It is Women in Housing and Finance, and it's made up of women who work in, housing and finance, primarily affordable housing in the New York City metro area. And so it covers architects, lawyers, individuals who work for the city and the state and the public sector, as well as the private sector as well. And so it's primarily a networking organization. They hold events throughout the year. We also host a mentorship program. We do an executive table speaking series where we invite very senior individuals working in affordable housing in New York City to come and speak to an audience that then rotates, so they get to speak to each of the different executives. And then we also host brown bag lunch series, so that, I think it's every other month, we'll pick a different topic and have a subject matter expert come and speak, whether it be to, receiving homeless vouchers so that tenants can move into buildings, or to talk about the insurance process. We just like to highlight different areas. And obviously, as of the last couple of years, sustainability has been a huge area of focus as well. So we're trying to dig a bit deeper into that.
So you mentioned kind of people in senior positions come in to talk. And I imagine that you're probably looking for women to give those talks.
Yes, of the years that I have been a member and on the board, the focus has been on drawing in female executives in these roles. Yes.
Is finance a career niche where women have risen to top levels, so that there are senior executives who are women that can easily be found to come in and talk?
This is not based in any scientific research, but I would say at least in the affordable housing finance space, there are many women in senior and executive roles. The former head of HPD was a woman. The head of CPC, which is Community Preservation Corporation, which is a CDFI, is a woman right now, the executive director. And so, and the the head of the deputy mayor for housing and economic development at the city right now is a woman. And so, there's a lot of opportunity for us to invite specialists to come in and speak to this topic. I think that once you start moving out of affordable housing finance and go into more traditional finance paths, I would say that, there's probably still a disparity between men and women at the top. But I would say that in the affordable housing space, that there are many women working in executive roles.
Interesting. And one other thing I wanted to go back to that you were talking about, because I found this really interesting, was that when you were thinking about what you wanted to do, that urban planning was something you just had never heard of. And, I think that you're not alone in this, in finding a career in something that had never occurred to you to think about. But I just also find it so interesting that there are these careers that in high school you're just never exposed to. So I just was wondering if you reflected on that at all when you were like, oh, the light bulb went off. Urban planning, like, did you think back and think, well, why didn't I think of this before?
Yeah, I think not only did I reflect on it then, but I think I'm continually reflecting on it, because it's how do we, especially growing up on Long Island, it's the traditional cop, fireman, teacher, or upper tier bank lawyer, of lawyer, doctor, etc. And
finance is definitely
and finance, yes. And there's just, even with my husband's role in marketing, and maybe this is just specific to me and my lack of exposure growing up, but there's so many career paths and career opportunities out there, and I just think in general we need to do a better job of exposing the youth, for lack of a better term, to the different opportunities that are available to them. And I think that there's so many different career paths. And even when you're selecting an undergrad major, it's still, and I haven't done this in quite some time, but I would imagine that it's still a bit siloed into different career paths. And maybe it's just the experience of going to school and meeting others. But, I think it's important to be able to broaden your opportunities besides your immediate network. And so, I think New York, the city at least, is trying to do that with some green jobs, or they have on Randall's Island, I know that they have a program that is a high school program that's specific to even the Governor's Island waterway restoration. And so they teach people to even go down into the water. And I think they're scuba diving for oyster restoration, or just really niche opportunities. But yeah, I think in general, exposure and diversification and meeting different groups of people all helps to be able to expand your worldview and what you want to do and contribute.
But I think a big thing too is to really look at everything more holistically, because for me, urban planning was always categorized with architecture, right? That was for us kind of a path. You either become an architect or an urban planner. But even as an urban planner, it was very, very much, kind of a perspective of the planner, the architect, and not necessarily financing. So I feel like that you went this path and ended up in financing shows that there's just so much value in crossing paths and looking at everything more holistically and from different perspectives, right? So I think that's what's really interesting for me, because financing that was definitely not on my radar.
Yeah.
Going through
I will say at Wells, I am the only person with an urban planning, or in our group, an urban planning background. And I think that, again, just talking to having a diversity of perspectives on teams, it's super important, because while the majority of my team has a strong finance background, since we are financing affordable housing and working with the city agencies in a public-private partnership, it is helpful to have a perspective of having worked at one of the agencies that are providing the financing before. And so I think that that's my value add to the team, is having a bit more perspective on some of the issues that we encounter or not even issues, but as we work together to finance hundreds of millions of dollars of affordable housing each year. And so I think I'm happy to have a diverse background. I think it adds value to my role, not only at Wells, but as I continue to go on in my career. I think that it will, just continue to provide value.
I mean, in your environmental studies background, you get exposed to systems thinking, ecosystems, systems thinking. And that's also a great perspective to bring to urban planning, just to have that bigger picture exposure. So yeah.
I mean, especially when I was at NYU too, I did a fellowship program with the Office of Emergency Management, New York City's Office of Emergency Management, and this was coming off the heels of Hurricane Sandy. So it was 2013. Sandy happened in 11. And so, Manhattan is an island. The outer boroughs are all surrounded by water. And, we have some serious infrastructure issues in New York City. And so, how can you not, when you're building, and especially when you're building for a vulnerable population, how can you not take those things into consideration? And I think that it's what we were talking about earlier about resiliency and insurance. I think that those, are you in a flood zone, right? That was the biggest question that you had to hurdle. But I think that even in New York, we're seeing just these rains in the hurricane season are just completely decimating homes, the subway system. It's completely putting the city to a grinding halt, and it's a big issue that we're going to have to confront. And just like buildings emit 40%, I think, of the greenhouse gases, it plays a large role in our future planning.
So do you feel like there's a much better understanding now that all these natural disasters are happening, a better understanding of urgency?
I think we're almost on the pendulum has swung so far in the other direction that there are so many issues to confront that I feel like now the problem is how to prioritize what needs to be addressed, right? And just, not to go too off track, but just the fact that income disparity has risen so much in the past couple of years, especially through COVID. It's, we're still, and the migrant situation in New York, there's a lot that needs to be addressed. The issue or the solution is holistic, right? And so hopefully it will be addressed that way. But there's a lot of different things going on. And I think that unfortunately, just even being able to find shelter and provide food for individuals is becoming the priority, as it should be. But there are a lot of other issues that need to be confronted as well.
Which circles back to the question of the supply of affordable housing, but also how resilient is that affordable housing? And I've been spending a little bit of time reading this research study that's come out about how to value resiliency. And I just wonder if that comes into your financing at all, like putting a dollar value on resiliency. How do you value that? Is that something that comes into your work at all?
Not yet a dollar value. I think that there's certainly there is absolutely a qualitative value being put on the sustainability initiatives. And so when we present a financing opportunity, we are, highlighting if there are any opportunities from a sustainability perspective. And so that includes not only energy efficiency measures, but also affordable housing. Which is why, our group, we're in a very constrained capital market right now. But for the community lending group, we can also often slip through because, we're able to promote these sustainability measures, whether it be from a resiliency, energy efficiency standpoint or from an affordability standpoint. And, Wells also is adding value for investing in diverse sponsors as well, right? So we're looking to invest in minority and women-owned business enterprises as well. I think that we're getting closer to be able to putting a dollar value on it, but that's a very complicated equation. But I do think that that is the next step, is to actually be able to put a dollar value on some of these benefits.
Does that have anything to do with, like you mentioned, insurance earlier, right? And we know insurance has been going up like crazy, right? Based on all these disasters and everything. Does that tie into value, like dollar value at all in your perspective, or is that something completely different?
We're focused on insurance from, first of all, the ability to receive insurance, for a building to receive insurance, right? So the building needs to be insured, during construction, and then in order, like I said, to receive that construction pay down from a permanent financing opportunity, there needs to be insurance at the project. And so for the building to be insured is a major concern to us. And then next on the list is, what is the cost of providing that insurance? And over the past couple of years, the insurance market has constricted significantly. So there's only a certain number of players that are actually providing insurance. And we're seeing a lot of redlining in the affordable housing space as well, meaning that, they're either charging X times what their normal premium would be to provide housing to affordable buildings, or just not offering it at all. And so from our perspective, the city and state rely on what we call a maintenance and operations expense chart. And so all buildings underwrite to that chart. But because insurance has become so unwieldy, that they're actually allowing sponsors to come in with a quote that they receive from the insurance agency, and then we can underwrite to that actual amount, as opposed to relying on their portfolio, which is where the rest of the expense information comes from.
Yeah, I mean, as you say, the constriction in the insurance market is just affecting everybody, from single family to large projects. And, who knows how we're going to work through that, because disasters are becoming more and more expensive. I mean, you can understand why the insurance market is in dire straits.
Yes, I often wonder if in years to come that it will be something that will be provided at the federal level, and there won't be any private insurance carriers anymore, given the state of affairs. But to be seen.
Yep, to be seen. Well, on that perhaps less than happy note, but maybe looking forward to a future where insurance is not so difficult to obtain. I just want to thank you so much for your time. It's been really great talking with you.
Yes, you as well. Thank you.
Thank you for all your insights. I feel like financing is always something that comes a little short. We always talk about building science and how to build these buildings, but the financing is the factor that makes it all work at the end, right? So
yes.
Thank you.
Thank you.
And that was Katelyn Meehan from Wells Fargo. Awesome discussion there, and a whole bunch of stuff that I haven't necessarily thought about, but, well, I kind of guess I have thought about some of the financing side of projects, but often leave it up to someone else, or feel like it's an area that, as building scientists and people interested in performance of the thermal envelope, we don't necessarily get involved in. But I really enjoyed that, and I found it very informative about that world of how finance works. Mary, do you want to kick off anything that jumped out at you? What was your highlight?
Well, definitely the rollout of this green loan commercial real estate program that they got approved at Wells Fargo, and which is very exciting that there are some concrete financing benefits for getting Passive House certification or other green building certifications, which I just think that's great. Finally, it's a message that is important to deliver to developers.
Yeah, Absolutely. I really like. She explained that progression really well, which we have seen, but it's also interesting seeing that across the wider industry of quite a good level of understanding and brand recognition of LEED. And then there were these things sort of called Passive House Light, as people kind of heard about Passive House but didn't really know what it meant, or it seemed like quite a high bar. But now really driving that benefit of actual certification and verification of buildings to really ensure that performance. And to see that the value of certification from someone like a financial institution, I think is a really positive step forward. Ilka, what did you take out of that?
This was all fairly new to me as well. And it was great to learn about these loans and tax credits and all the things that are already in place. For me, what was really interesting was to learn about this takeout loan, where she said that and how that works with the underwriting, that right now they don't actually underwrite energy savings on a passive house, but that they do recognize that a passive house or under other green building standards make the savings and utilities a little bit more predictable, and that maybe in the future they can actually underwrite this. So this whole concept was interesting to me.
Yeah, I found that really interesting too, and I can definitely relate to that, and particularly being in a more temperate climate. We talk a lot about the energy savings, of being energy efficient and as a sustainability feature, but to find proof of that and to get evidence of actual savings, operational savings on buildings is actually quite hard. Part of the issue here is that standard buildings, existing buildings are drastically underheated. So when you provide nice, warm, dry, efficient buildings that can be heated, it's very hard to do a cost-benefit analysis, because we're not comparing apples and apples. We're comparing cold, old buildings that aren't heated enough with new buildings that are warm, dry, and healthy. And without controlling for the difference in temperature, it's very hard to actually quantify any potential energy savings, because people don't necessarily save what the energy model says they should save. They just end up being warm, dry, and healthy, which is a massive benefit. So seeing how that evolves when it comes to selling the benefits to someone like a financial institution, I think is really interesting. What stood out for me was talking about insurance and the fact that passive house buildings are potentially more insurable. And that's another really important, increasingly important aspect of building finance as insurance premiums go up. And that seems like it's a bit of an emerging area as well, which will be very interesting to see how that plays out. Zach, what were your takeouts?
Well, I was heartened by this increased awareness that banks have of passive house, and was reminded of an anecdote that Sloan Ritchie shared a few years ago. Sloan is a developer and builder here in Seattle who has done most of the larger passive house projects here, and he was sharing that just a few years ago that he never talked about passive house with banks anymore, because when he did bring up passive house with banks, their response was, "Oh, that's the thing where you dig a big hole and put a bunch of rocks on it and then put a house on top of it or something." And they're like, "That's really weird." And so there was just this place where there's just total misunderstanding of what passive house was, and it was kind of like a red herring, or not. It was just it led that project down not a very productive path with the lender. So the fact that we're now in a place where Wells Fargo is recognizing passive house and giving more favorable terms on lending because of it, I think is really great progress. And so that's excellent. I also was glad to hear that from her perspective, she's not seeing that there's a make or break added expense for pursuing passive house. That's also great to hear. This is part of. I think that there's a little bit of a wave happening here in the finance world. We were just at FIASCon. We also heard from the folks at Pace Equity. What is it? Performance Assessed Clean Energy, I think is what Pace stands for. But it's essentially a way of providing more favorable terms for an energy efficient building. And Pace Equity announced that their Cirrus low carbon product, which has a savings on the interest rate, now automatically, if you do a FIAS project, it automatically qualifies. So there I think in lots of places, not just Wells Fargo, but other players in the financing world are recognizing the importance of resilient, energy efficient buildings. And I think a great point was made. If the bank requires certification, then it automatically kind of de-risks the decision for the bank, because it's one that they're not making the determination of whether it meets the mark or not. We have this trusted third party that's doing that, the certifying body.
Yeah. I had visions of you, Ilka, standing in front of a boardroom trying to explain Passive House in 5 minutes to people who obviously might think that it's a pile of rocks. Is that correct?
I definitely had a flashback to 10 years ago where everyone just was looking at me with big eyes and I was trying to explain what this is. And at the end, I mean, it just comes down to numbers. And back then, unfortunately, Passive House was still quite more expensive. So, everyone was on board pretty much, according to what Passive House was promising. But then again, back then, the financing didn't really quite work out as they are now.
Yeah, well, hats off to Wells Fargo as well. I mean, and also to Katelyn. She mentioned, about 18 months of work as being standard for getting a new product introduced. Banks are big institutions. They're pretty risk averse. So it takes people, I imagine, like Katelyn to be passionate and persistent to introduce something like this to the market. And it happens over time, and staying at something for that period of time and convincing senior management to give it a go is no small task. So, she's obviously done a really great job there. And hopefully other institutions will pick up on this and see that there is an opportunity there, particularly in that affordable housing market as well. I think that's a really interesting space because while in some instances the margins might not seem as great, there are some substantial benefits and relatively secure investments as well, I think, over a long period of time. So I think using private banks and other financial institutions to assist with the creation of not just Passive House high performance buildings, but also affordable building projects is a really exciting new development. Any final thoughts to wrap up?
I actually would like to talk a little bit about the tax credits, because she talks about the 45L energy efficient home credit. And I think it's just really interesting or important to recognize and know that there are tax credits available for energy efficient homes now. And I think I looked it up, there's a 179D for commercial buildings as well. And I just know from experience that tax credits can absolutely make or break a project as well. We've used a lot of historic tax credits or new market home tax credits. And without those, sometimes our projects would not have been able to go through. So I think it's important that people know about that option as well.
All right. Hey, well, thank you, Mary and Ilka, as always. Great interview. Really enjoyed that. Really informative, finding out about an area that some of us, probably some of our audience, don't necessarily think about, but I think is becoming increasingly important, and a really great opportunity to team up with not just construction lenders, but also mortgage brokers, financiers of building projects, and then also the insurance side of things is a whole other area that we should probably delve into at some point. Great stuff. Zach, I don't know if we need to mention other upcoming events other than just people should go and check out Reimagine.
That's right. Yeah. That's the big one. It's going to be our focus. We'll have a link in show notes to both an article about the conference on the Passive House Accelerator website, which includes that video reel, and then also a registration link to the conference site. And there's going to be all sorts of opportunities, not only to take in really top flight presentations by leaders from around the world, but also to network with peers in your region and also globally. So we're gonna, as is our style, we're gonna make sure that there's lots of chances to connect in fun ways. So we're super excited.
I'll just do a quick shout out for Passive House Accelerator on Instagram. As well as YouTube. We've got the 2 channels there on YouTube, but there's some really, really great content. So you can just search up at Passive House Accelerator on Instagram. If you're not on a browser, always looking at the website. It's a great place to follow new content and upcoming events there.
Absolutely.
Awesome. All right. And we still got some special episodes coming out in the stream.
Yes, we do. With the FIASCon coverage, lots of great interviews still being produced for bonus episodes of the podcast. So, yeah, check those out on the street. You probably, people who are listening to this saw those as they were accessing this episode. So, really great stuff.
Excellent. All right. Thank you very much, everyone. We'll be back again next week for a regular episode as well on the Passive House Podcast.